welcome to Fundsindia's Market Lounge Reloaded, and I'll be moderating this session. Today we shall discuss pitfalls to avoid when choosing equity funds. Mr. Arun Kumar, our research head, will start the session.
Yeah, hi everyone. Thank you so much for joining today. So we have a very interesting topic. This is a topic where I have spent a very long time trying to figure out an answer. So probably during the presentation, I'll probably let you. I mean, I'll give a sense of what was the problem that we were trying to solve. What's the kind of solution that we have attempted, and what was the broad thought process, right? Now when it comes to picking equity funds, fundamentally the problem starts with a simple thing that if you look at most areas in life, generally whatever happened in the past, so let's say we are recruiting a candidate. If that candidate is from some top B school, say IIM or IIT or some Harvard or Stanford, and then let's say he's worked at a top firm for say 10 years, and generally you know that that person should be good enough, and then obviously there'll be an interview and all that, but usually 9 out of 10 times you know that once the resumes are good and you check for the attitude, broadly they become a good fit for most organizations, which means what that particular person has done in the past is a very good reflection of how that particular person will do in the future. Same thing when it comes to choosing restaurants in Zomato or choosing any product in Amazon that we want to buy. We generally go look at what are the ratings and what are the others saying, what has been the past experience of other customers who have bought this. So broadly, you can almost all areas of life, past performance is a great indicator. So generally, when it comes to mutual funds, it is very natural and it's very intuitive that all of us, including our clients, will obviously look at what has been the last 5-year performance, what has been the last 3-year performance, just to get a sense of which is the fund which is doing well. And if something has done well over the last 5 years, 3 years, then the natural assumption is that this particular fund is a good fund and hence it will continue to do well. So this is supernatural. Now let's look at what is the problem with this. This is very counterintuitive. So instead of giving you some different tables or graphs, I just wanted to give you a sense of what happened in one particular very decent long-term performing fund and how it went through different phases. Now, if you look at 2017, okay, this was a news article which came in Economic Times. Okay. Now you can say that the headlines is fairly simple. Why is Axis long-term equity fund underperforming? Now the interesting part is actually not there. If you read through that first few lines, right? So first few lines are very simple. In its relatively short existence of 7 years, Axis long-term equity fund has earned a name for itself. And then comes the important line. It was almost on the recommendation list of every mutual fund advisor in the country till recently. Okay, so which means that till 2017 or till 2015-16, it had a super duper performance. And then from 16 to 17, the fund had started to underperform. So there was a dilemma saying that, hey, this fund was doing really well. Everybody was recommending it, but suddenly it has started to underperform. Then you can see the Axis fund managers' response that, hey, the market has not been conducive for quality businesses. They were running predominantly a quality oriented investment style as their major strategy. So this has underperformed. Okay. Now let's see if somebody had gone by past performance and they bought into this fund and now they see their fund underperforming. What will be the natural reaction? You see last 3 years it's underperformed and hence let me move the fund out. When I put the fund in, it was a good fund. Now the performance is bad and now I move out of it. Very simple logic. And most advisors would also do that because they say, hey, it was a good fund. Now it's a bad fund. Now let's remove out of this. Okay. Now let's look at what happened a few years down the line. This was the news in 2019. So look at the date, July 13, 2017, just 3 years hence. So this is the time when everybody was moving out of this fund. And the newspapers were saying funds are underperforming and probably the fund has lost its touch. And then you can see exactly 2-3 years down the line, The headlines is just the opposite, which says investors obsessed with equity schemes of Axis Mutual Fund, says advisors. You can again read through this. This was an article which came in ET. The mutual fund investors want to invest only in equity schemes of Axis Mutual Fund these days, say mutual fund advice. So which obviously the performance in 18-19 was supremely good for Axis. So I remember that all Axis funds were doing well. Because that was a time when I also joined Fundsindia, and almost like all of our wealth managers, they were asking me saying, shall I give Axis mid cap? Shall I give Axis small cap? Shall I? So it was almost everybody was convinced that Axis was the only fund available, because the performance were extremely good for across the AMC, right? And which was obvious. So the clients liked it, advisors liked it. Just look at how this whole narrative changed within 2-3 years. Okay. And then you had some interesting videos by ET Money, which said, why are Axis mutual funds outperforming? All of these in 2020 end. And then again, the flows were supremely good. So I think in 2020 and 19, Axis had one of the highest equity inflows. I think they were the topmost AMC with the highest equity inflows. So everything hunky-dory. So 17 was bad. Everybody wanted to give up. By 1920, the entire world was convinced that Axis is the only mutual fund which is doing extremely well, and all of our money should go to Axis. And let's look at few months down the line. This is the news item on April 7, 2021. So in 19 end and 20 mid till 20 mid, Axis was the only game in town. But just 1 year hence, look at what are the headlines. Axis mutual fund equity schemes lose sheen as growth style fails to pay off. This was a Live Mint article. Then again, the same article. Investors' favorites, Axis Blue Chip, Axis Long Term, they have both significantly underperformed in the last 1 year. Same thing. Another scary article from ET, which says several equity schemes of Axis mutual funds are underperforming. What should you do? Now, broadly, if you really look at this, right, this is the challenge. This is the fundamental challenge of picking equity funds, especially active equity funds, which are managed by good fund managers. Right? Now, you can see while Axis long-term equities, 5-year, 10-year, 7-year performance looks really great. But the point is, just like all other funds, Axis also, any good in fund for that matter, will go through its period of tough times and will go through its period of exceptional good times. Now, in good times, we assume that this is the best fund, and in bad times, we assume that this is the worst fund. And so we come in during the good times, after the good times are done, and then we enter and only to be surprised or disappointed in the next 3 years. Then we leave the fund, and then again, just to see that after 2-3 years, again, it's become the top performing fund. So because of this very counterintuitive happenings, a lot of us end up with very poor experience in picking mutual funds, because we are not able to stick to any particular fund. Now you might say, hey, Arun, this is only for Axis, but what is the evidence that this is seen across the other funds as well? So what we did was, this is looks like a very heavy table, but let me explain. This is a fairly simple one. What we did was we asked a very simple question. Let's take the top 30 funds based on pure past performance. Like I put all the diversified funds together. So let's say you were in 2009 to 11. Okay. In 11 end, you were figuring out saying which was the top performing fund. Okay. So last 3 years, I look at it and I ranked those funds from 1 to 30. And all I asked a simple question was, these 30 funds, what was their rank in the next 3 years? Because I don't know what is going to happen in the future at that point in time. But because we are doing an analysis based on the past, we wanted to see in 2011, if I had picked the top 30 funds, how many funds actually continued to be in the top 30 over the next 3 years. Now you can see a lot of reds happening, which means that a fund which was 9th fund, which became the 120th fund in the next 3 years. Again, 15th ranked fund was 104. So you can see a lot of reds happening. Now, this is not just a trend for 2009, this particular period. We again went and checked for 2010 to 12, what happened in the next 3 years. Again, from 11 to 13, what happened in the next 3 years. Again, from 12 to 14. So like that, we did it for the last till date. We started doing this, and we broadly found that this is a recurring pattern. Whatever, especially in certain periods where there are inflection points like 2013 to 15 and 16 to 18. You can see that the number 3 fund became 166th rank fund. Number 4 fund became 140. Number 5 became 160. So imagine that you had picked top 5 or top 10 funds. And then in the next 3 years, if you look at it, your ranking of your funds are almost in 80s to 100s to 166 to 140. So which means again, you will be disappointed and again, you will move out of these funds. So this is one way to look at it. So which means that this trend of the past performance not continuing is a perennial problem, and it's not just, and sometimes it's very, very acute, especially when there are inflection points. But for most of the years, you can see that a lot of funds are not able to replicate their top performance. Okay, so which means if you only look at past performance and only pick the top 30, any fund out of the top 30, you might be there is a lot of chance that you might get extremely disappointed in the next 3 years. The other thing that we did was we did the same analysis for a longer period, where we said we'll take the top quartile funds and look at on average how many funds continue to stay in the top quartile. It's a very similar analysis, but for a longer time frame. On average, out of 4 funds, only one fund remained in the top quartile. So which means that there is a very, very low probability of the same funds continuing in the top quartile. This was done on a 3-year period. And on a 5-year period, there was only 1 out of 5 funds. The repeatability even further reduced, right? So out of 4 funds on a 3-year basis, only 1 fund was able to, on average, was able to continue its top in the top quartile. And similarly, on a 5-year basis, if you pick funds on 5 years and then waited for the next 5 years, you found that only 1 out of 5 funds continue to be in the top quartile. So which means 4 out of 5 funds were no more in the top quartile. So overall, we can broadly see the trend that we saw it anecdotally. And I'm sure that all of you will have some sort of an experience in this, where you recommended a particular fund, and once you put that particular fund in all your clients' portfolios, then after 2-3 years, you find that the fund is disappointing you. There are several examples. There was a fund called Reliance Equity Opportunities, which was a super duper fund. The fund called ABSL Frontline Equity, which was again for almost like 10-15 years, it was the number 1 consistent performing fund. Again, there are lots and lots of HDFC equity was once upon a time one of the top performing funds. It was the largest fund in India because everybody wanted to invest there. Kotak Standard Multi-Cap became the largest sized fund, and it had phenomenal performance. But again, it has underperformed in the last 3 years. So Motilal Oswal FlexiCap was a classic case where they had super duper performance in the first 3, 4, 5 years, and then now they are drastically underperforming. So you can see there are hundreds of these different cases happening in mutual fund industry. Now the other problem is also on the rating front. Okay, now a good way to think about, so now past performance is not a great tool. And again, if you really look at ratings, they're fundamentally a very complicated way of measuring the same performance. They do several metrics and all that, but if you really arrange all funds as per their performance and then look at their ratings, more or less they will be in line. Okay, so the key question to ask is that if these rating funds have done really well in terms of picking funds which outperform in the future, obviously they would have gone left, right, center and advertised to the entire world saying, hey, this is our rating process, this works, and please do subscribe to it. Now, if you look at both Value Research or Morningstar or any other large research agency for that matter, you will not find a single report which shows that, hey, over the last 15 years, these were our 5-star rated funds. This is how in this 3 years, whatever was rated 5-star, what was the future 3-year performance? That you will never ever see, right? So isn't this strange? Because they are into the whole activity of rating funds, but there's not a single place where you will find that where they show their track record. So which fundamentally means that if the track record for their ratings was good, they would have obviously showed it to us, because that's like the best thing to do, right? Now, because it's not good, Morningstar has not done it anywhere in the globe, anywhere it has it advertised. And in fact, there were a lot of studies saying that do Morningstar ratings actually predict the performance? Broadly, what was found was that the star rating processes had only a very moderate predictive power, which essentially means that it is a small part of the overall fund selection process, but you can't blindly go by this. And the predictive power is not too high. So Morningstar itself tells us that, hey, don't go only by this rating. Probably if you are measuring 10 parameters, out of the 10, use this as one of the parameters. So this should only be one of your inputs, just like how a doctor checks several, maybe heartbeat, temperature, blood test, and all different. Morningstar says, hey, this is just one of it, but just don't go only based on this. Okay. So overall, the hard truth for us is that past performance is not a good indicator of future returns, and which is too evident by all the evidence that we've seen. And the key important thing for us is any product, any investment product, any equity investment product that you buy can never give you consistently high returns every year. Okay, all these products will have their bad times, and all these products will have their good times. Okay, now good funds will have bad times, but their good times will more than compensate for it. And over a 7-year, 10-year cycle, these funds end up outperforming their benchmarks at a decent rate. Right? But however, in the short run, maybe 1 year, 2 year, 3 year, 4 year, 5-year time frames, all these funds inevitably will have to go through their bad time. Now, if a particular fund has not gone through its bad time for 10, 15 years, then it means inevitably it is gotten lucky, and inevitably it has to go through the bad times. And there is no fund which has escaped this bad times, be it globally or be it in India. So this is what I call the frustrating law of mutual funds or active mutual funds, which is that for any disciplined investment approach to outperform over the long run, there's no other way, but it has to experience some sort of an underperformance at some point. This is very, very important, because if we don't intuitively understand this and accept this, we will find it really difficult, and we'll only keep moving from one performing fund to the other, because by the time we enter the performing fund, it's underperformed, and then again we move on to other one. So in effect, we will end up becoming, this whole mess will happen to our portfolios and our client portfolios. So, and you might say, hey, this is for Indian markets, but do the global markets also prove the same point? This is the best investor that all of us know, which is Warren Buffett. You can see that Warren Buffett also, several points in time in his career, has underperformed the benchmark drastically. That too, you can see the first instance where he underperformed by almost 18%. Then he underperformed by 25%. Then there was one more instance, 96, 98, where he underperformed by 22%. Then almost by 54% during that in the 1998s. So you can see that at a lot of times, Warren Buffett also has been underperforming the benchmark in the short run. So this is almost like a given. Now the key question for us is, one, we have seen enough data that past performance is not is one of the indicator, but if you only go by that or only go by rating, we will end up with a very, very disappointing experience. Now the key question is, why is it happening? Because in every other field, the past is a good indicator. Why is it that if the last 5-year returns are good, my next 5 years, why is at least 4 out of 5 funds, why is it not staying in the top? What is really happening, right? So there are different reasons for this. So one of the important things that we have to realize is that at different points in time, what happens is that one set of stocks or sectors gets hyped up, okay, which means suddenly there is a narrative around that, there's a story around that, and then everybody wants to invest only in this sector. Okay, so the fundamentals of the sector will be strong, and then that will have a very strong story. But suddenly, because everybody in the world believes that, and then everybody gets into that, the valuations become insanely high. So all the future growth, all the narratives around that gets captured in the valuations, and whatever was supposed to happen over 10 years or 5 years or 10 years, all of them get captured in the price in a span of 1 year, 2 years. And then because the returns are insane, everybody gets into it. So this is what usually leads to a bubble. So 1999, there was a tech bubble where all tech related stocks became insanely expensive. So any fund which was doing well due to higher participation in tech was a superstar for 2-3 years. But then when it broke, it became the worst performing fund. Recently, there was a fund called ARC, which is managed by a fund manager called Katie Woods. She was the rock star in 2020 middle because all her stocks had done really well, and she was like outperforming almost every other fund on the planet by miles. And then right now, the fund is almost down 65-70%. So it's going through its toughest ever time. So all the investors who started looking at the performance and then entered, they're going through their toughest time period ever, because NASDAQ is down 30%, S&P 500 is down 15-20%, while this fund is approximately down 65-70%. So you can see all the returns that it got, everything is kind of vanished. So you can see that this is what happens once you load up on these very, very expensive stocks. And then 2007, there was this infrastructure real estate bubble. Anybody who did, who had a high exposure to infra and real estate did supremely well till 2007. And then they had to go through their tough time. Again, 2017 was a classic case. All mid and small cap funds were doing really, really well. If you look at 3-year, 5-year performance, every fund was giving 25-30%. Every small cap fund was doing extremely well. And then all of us know in 18-19, small and mid caps went through a horrible time where small cap funds were almost down 30-40%. Again, mid cap funds were also down 20-30%, while your large cap funds were actually up some 5-10%. So you can, and then right now there's a quality theme, there's all quality stocks will, you don't need to look at valuation. So there are different narratives going on, but quality as a theme has done really, really, really well in the last 3, 4, 5 years. And the valuations have also become very expensive, but most of them have got corrected in the last 1 year. So broadly, you can see that these kind of, and then there'll be a lot of micro things with NBFCs were a craze till 17. Till the crisis happened, and then there was a real estate craze till 2008 to 13, and then there was power craze from till 13. Then pharma did really well from 12 to 15, and post that it didn't do well. So, and consumer companies started doing well post the 2008 crisis. So all of these are cyclicals, but the real problem is that sometimes it's driven by fundamentals. Sometimes the fundamentals are there. But the point is everybody enters and then the valuations go out of whack, right? So which means that if your fund is performing because of its exposure to these bubbly segments, so then it means that it will do really well. But once the bubble breaks, then the fund will go through a very tough time. So the first thing we'll have to check is that, is the fund's outperformance primarily due to some particular segment of the market which is done extremely well? And if this reverses, the fund can drastically underperform. So this is the first thing that you will have to check. And this is the first reason why a lot of funds suddenly show a sharp deterioration in performance. Katie Woods being a classic case. It's a recent case, so you can all Google and then check on it. But it's a super interesting case study for all of us. The other thing is to broadly understand how large, mid and small cap performance happens. So you will find some phases where everybody says, oh, only invest in small caps and mid cap. And you'll have some phases where people say only invest in large and mid. Now, the best way to look at this instead of getting too disoriented is to look at the long-term trend. You can see that from April 03, the cycle started. And then the blue line is the large cap. You can see that initially till the bull market ended, small caps were just beating large caps left, right, center. And then the crash happened. More or less, all three ended up with similar returns. Again, same thing happened again. Your small caps again outperformed drastically. And then again, when it cracked, it all ended up with almost similar. So you can see that at the end of the market cycle, large caps, mid caps, small caps almost had the same return. Same thing again happened till 18. And then again, it fell. Now again, it is happening. And we do not know at what point it will happen. But the point is, history tells us that depending on which part of the cycle, there'll be small cap, mid cap, or large cap, which does extremely well. Now, the point is, if you look at only one part of the cycle and you look at the past performance and say in 2018, hey, mid and small caps is the best fund, I will only invest in mid and small caps, and then I won't have any large cap exposure or flexi cap exposure, you will suddenly see that 18-19, you are in for a huge disappointment because the cycle essentially ended. The other way to look at it is the same thing, but in terms of year on year, you can see that till 18 and 19, so 14 large caps was worst performing, 15. So just imagine this, 14 large cap were 35%, while small cap was 70%, almost like a 35% underperformance. Again, it underperformed in 2015. Again, it underperformed in 16 also more or less, and then 17 huge underperformance. So almost everybody had given up on large caps, and look at what happened in 18-19. So if you looked only at the past performance in 17 end, then you would be in for a very, very drastic disappointment. So first thing to look at would be to see if there are any bubbly signs or any sector or any particular set of stocks which are becoming more and more expensive And does your particular fund's past performance, is it mainly due to that? That's the first point. Second thing, you look at what is my small, mid, and large cap exposure, and is it getting disproportionately getting benefited due to that part of the cycle where small and mid caps are doing well or large cap is doing well. Okay. The other important thing that you'll have to look at is there's something called investment styles. Okay. Globally, what they have done is a lot of research has gone on figuring out saying what are some of the rules that we can apply so that over the long periods of time, we can get a decent outperformance over the common benchmarks. Okay. And broadly, the styles that they had identified was value, which essentially means you buy a cheap in the sense you buy companies at very low valuations. And because of the valuations coming up, you will make money. Then the other one would be like buy small and mid cap companies. And over long periods of time, they will outperform large caps. And then you do low volatility, which is like stocks which are very, very low volatile. They will also tend to outperform over long periods of time. Again, quality, which is what Axis follows, where like you buy super high quality names, though they'll be expensive, but that is still fine. But over long periods of time, they will do well. Dividend yield is another style where you buy high dividend yield companies. Global is like you take global exposure. Then momentum is basically you buy stocks which are currently doing extremely, extremely well. Okay. And then whenever they don't do well, you move on to the momentum is a very, very high churn strategy. So overall, while over the long periods of time, they found that this is able to beat the Nifty 50 or it is worked in US. Globally, they found that it's able to beat the common benchmark, the broad-based benchmark. But you can see that it does not beat in every year. Okay, so there'll be few years where it does disproportionately well, and there will be few years where it does disproportionately bad. But the only point is that during its good years, it will more than compensate for the bad years. So you can see that all these styles go through cycle. So there are quality did well from 18, 19, 20. And then in 21, 22, value has done well. So if you look at suddenly iPro Value Discovery, HDFC funds, Franklin funds have started doing well, while all the quality oriented funds, right, be it in Axis or Canrobeco or DSP Flexi, UTI Flexi, all quality oriented funds have started to underperform. And the context here is that particular style is not doing well. So you can see that this is like, it goes crazy. Suddenly value is doing well, suddenly value is not doing well. So again, if you only go by past performance, if you went by value alone, by 2020, you would not at all have any value exposure. But you can see that the whole thing has turned around. So the point is, we do not know when these cycles change, but it's very, very important to understand what is the investment style that your fund is. These investment styles will have their bad times and good times, but if you don't stay for that entire bad times and good times, because they will compensate for their bad times during their good time. But the point is that compensation of that outperformance will come in very sharp spurts. So within a span of 6 months or 1 year, the entire outperformance will be taken. So if you come into the fund after seeing the outperformance, then you lock in the bad performance. And then you don't stay till you get that huge outperformance at some point. Then you end up with a very bad experience. So the key point to notice is that all styles, okay, this is not just in an Indian context, even in a global context, all these investment styles go through their bad times and good times. And only over long periods of time, say 7-10 years, they end up providing decent outperformance. And you can see that different parts of the market cycle, different investment styles work. When they're recovery, usually mid and value does well, which is what you saw in the last 2 years. And when it's a slowdown, usually quality, minimum volatility, it does well. You can see this, that in GDP growth in India was slowing between 18, 19. So which is why there was hardly any companies which were giving growth. So whatever companies were giving growth, high quality companies, they were getting insane valuations, right? So you can map it with what is the economic environment, and based on that, different styles will do well at different points in time, right? The other way to do it is, this is an interesting slide from IDFC. They put value as all these cyclical sectors like corporate banks, NBF, cyclical NBFCs, auto, industrial, commodities, energy, utility, telecom. Then stable sectors are like your retail banks like HDFC, Kotak, stable NBFCs like Bajaj Finance, auto, consumer staples, consumer IT, pharma, specialty chemicals. And then they say, is there a cycle between the cyclical sectors and a stable sector? So this is the overall weight in BSE 200. So you can see till 2008, before March not to, right? In that cycle, cyclicals were only 36%, and your non-cyclicals, which is your stable sectors, were almost 64%. But in the entire cycle, the cyclicals did really well. And by the end of the market cycle, almost it was 71% of the overall index, while your staples or the stable part of the BSE 200 became only 30%. And in the next cycle, this just reversed. From 29, it is again gone to 64. So if the cycle is reverting, so whoever played only cyclical still here, they would have had a bad time in the next 5 years. So whoever played high quality in this 10-year period, they would have done really well. So which is why if you look at old AMCs like HDFC, ICICI, Naren and UTI, Anup Bhaskar, you will find a lot of Franklin. You will find a lot of these fund managers were good during this cycle because they had played the cyclical. Okay, now because this is their strength, when they tried the same thing, now the environment was not in favor for them. But recently in the last 2 years, it's again become favorable. So which is why you're saying suddenly that, so if you only went by past performance and you didn't put this cyclical change into context, then again you would be disappointed. And on top of it, the global markets also do differently at different points. USA did well, suddenly China did well. I think 2-3 years back, everybody wanted to do in China. Now nobody wants to touch China. So different parts of the world also does different. USA was doing really bad between 2001 to 10. And in the last decade, USA is the number one fund. Like almost everybody wants to invest only in US. So you can see that even within countries also, they will go through different phases, right? So overall, what we realized was very simple, that why doesn't the past performance work? One, there is a lot of stocks which become very bubbly in nature, stocks or sectors. And if your fund is only participated in that, and then the past performance should be looked at with a lot of fear, or a lot of, you should suspect that, because what if the bubble breaks, this fund will go through a bad time. Then you have to see what is the mid cap, small cap, large cap exposure, and how much of the cyclical component, right? Because at some point in mid and small caps will do well. Because of that, is the fund doing really well compared to any other fund? Then you look at what is the different factors or different styles. Is it value oriented? Is it quality? Or is it mid and small cap biased? Or is it growth oriented? You look at, or is it momentum based fund? Look at what is the style, and then put into context saying, am I comparing this particular value fund with another quality fund, which means my analysis will be wrong. So if it is a value fund, then I need to show how did other value funds do, though it might be in the same large cap category or flexi cap category, so that you have a little more context. And then you have to take a call saying, if I only end up with past performance, then I might end up only doing value or only doing quality. And then the cycle changes, I will have a lot of trouble. And then same thing between cyclicals and stable part. If I do only funds which are doing well and then they're only in stable part, when the cycle changes, my entire portfolio will underperform, right? And so you put all this together and also account into the fact that the globally also different countries do well at different points. And so all of this needs to be put into context before you take a call on the past performance. Now the whole question was, while all this is fine, how do we put this into action? Okay, now this was a huge problem for me for almost like 10 years, because when I joined my first firm, I was put in charge of picking up different funds and then building portfolios. And at that point in time, obviously, I didn't know about all this. So I generally did some very, very fancy MF selection process and all that. But what I realized was, more or less, it ended up mimicking the past performance. And it looked really good while I was recommending and all that. But inevitably, in the next 3 years, most of the funds were not doing well. Then we would give it a lower rating and then put on the next set of funds. But the point is, after like 5, 6, 7 years, right, you kind of realize that, hey, this game is keeping on repeating, but I don't know why this is happening. And then by 5th, 6th, 7th year, then you realize that maybe this is not working. But the point is, I really didn't know what was the clear answer in terms of why this was not working, because it's not very intuitive. Then we tweak the process and all that, but still net, as long as you're capturing the past performance, consistency in performance and all that, you will still end up with whatever is the segment that is performing really well. And inevitably, when the cycle changes, you will end up with a lot of your funds which are not doing well. So this was a huge problem. So that's when I joined Fundsindia. And to be honest, at that point in time also, I did not have a clear solution. All I knew was that sometimes you also need to consciously include bad performing funds, but managed by good fund managers, so that part, whenever the cycle changes, it can do well. But the point is, I didn't have a framework, or how can I communicate this to several lakhs of people? I did not know. And that's when we also had a product called Stable Growth 25, which was a low volatility based product, which was done by MSCI. They had an algorithm which will pick a low. And that's when I got introduced to this whole concept of factor investing. Factor investing is in essence saying that there are different investment styles, and you buy these different investment styles, and all these investment styles generally tend to outperform the benchmark or outperform the broader index over a 7 to 10 year time frame. But they also told that each and every factor will go through its tough time. So the simple idea at that point, okay, so there is something called factor. So then we asked ourselves saying, why don't we combine the factors so that when value is not doing well, quality will do well and then support me. If quality is not doing well, then value. This is the same thing that Indian cricket team does, right? There's a fast bowler, there's a leg spinner, there's an off spinner, there's a medium pacer. The whole idea is that the fast bowler might not do well in all matches, but the whole idea of not having all fast bowlers is that in different pitches, different guys will perform well, and overall at a team level, we will be sorted. So that was the thought process, and that's how we came up with something called the 5-finger strategy, where in essence we told that we will put 1/5 into quality, 1/5 into value, 1/5 into growth, 1/5 into mid and small cap, and 1/5 into global exposure. And we put them together. We will get a portfolio where we have very, very low overlap amongst these funds. And within each and every category, can we pick the best funds? Now, obviously, we tested this out. Simply, we put together the best fund managers under these styles and then combined them together and ran it for since Jan 1, 2010. So the back test was, we didn't do any major data mining. We just ran with whatever funds we had, and we found that the outperformance was significant, almost like 580% vis-a-vis 280% for Nifty 50 TRA in the last 12 plus years. Okay. And the last 10 years CAGR was 18% versus 14%. So it seemed a very promising concept. Okay, but all these key question is that sometimes these back tests work, but once you start implementing it, something or the other goes wrong. Now, thankfully, we've been implementing this from Jan of 2020, and we found this is the actual returns for our recommended set of funds under the 5-finger strategy. So we've made close to 62% absolute from Jan 20 vis-a-vis Nifty 50 returns of 44%. So as a concept, this is worked well for us. And so the broad idea is simple, right? You're just putting together 5 different styles and managed by really good fund managers and then letting them run. So we have not touched the portfolio. We've not changed any fund manager. We've just simply let them run. And we had like really good fund managers, all of them CIOs, all of them with 20-year plus experience, run these strategies for us. The other beautiful part was in the longer run when we tested, the whole idea was that over a 5-year time frame, 100% of the times it has outperformed, which is the basic case, right? Because all these styles have to outperform over long periods of time. If I combine them together, does the same magic work? So it's on a 5-year basis. It's been extremely consistent. And we found that 8 out of 10 times, it actually gave an outperformance of more than 3%. So 100% of the times it's beaten, and not more than beating. It's also beating it by a handsome 3% margin, 8 out of 10 times, right? And then the next question was, now I'm combining all of this, right? The beauty of it should be that it should reduce my declines, because when something is not doing well, something else does well, and overall, can it shrink my declines? So in 2010 to 11, again, it gave 18% vis-a-vis a 27% fall. Again, in Jan 15 to 16, it fell 9% vis-a-vis 21% fall. Again, in COVID crash, the market was down close to 40%, while this construct was down only close to 28%, right? Because quality stood up well and NASDAQ did well. And then when NASDAQ and all did not do well, suddenly value started doing well. So overall, the whole idea is not that we exactly know which is the category which will do well. Then we will only pick those 1 or 2 funds based on that style. But the idea is to put all of these styles together and let them run over a 5-year, 7-year time frame. So which means I'll be able to stick to the fund. At the same time, at a portfolio level, I'm able to reduce my declines or volatility. And at the same time, I'm able to give a decent outperformance over a 5 to 7 year time frame. So overall, within the 5 finger strategy, our whole idea is find out good fund managers who have good experience and who consistently deliver on the style. I don't want somebody who says I am a contrarian, but when quality does well, gets scared and then puts into quality. So there are certain funds. There was a particular fund which was quality, but then suddenly it changed into cyclical names. And then it underperformed, right? When quality was doing well. Now the fund is overall confused. When the quality cycle was there, it tried something else and it failed. And now when the quality cycle is kind of not in favor, they are again going back to quality. So this fund is drastically underperformed. So there are cases like this. So we look at is the style being consistent? Then we look at performance consistent over long periods of time, just to see if the fund manager is able to outperform over long periods of time. And then we look at various risk management. We look at what is the valuation. Is there too much of concentration? Is there too much of churn? Is there a liquidity risk, especially for small cap funds? And then does the fund take cash calls? Then we see whether they communicate well. Because sometimes they don't let us know how they are outperforming. So which means when the inevitable underperformance comes, it becomes very difficult for us to cater, at least stay with the funds. But thankfully, the communication is improving a lot in the overall AMC space. Then we look for size constraint as the fund become too big that it's not able to play the earlier strategy. Then broadly, we see if the AMC is fine. Is there any major concerns on it? So broadly, we look at all this, put together a set of 4 or 5 funds under these styles, and then we mix them together. Under each style, we pick one and then put together these 5 funds together. So overall, to sum it up, the key point is that do not look at past performance in a vacuum. Please look at context in terms of investment style. What is the market cap tilt, which is what is large cap, mid cap, small cap exposure, and where is it in that cycle? Look at the global exposure part. Look at what are the different cyclical versus stable component in your particular fund, and see if there are any bubbly segments being a part of your fund. And most importantly, remember that all funds, whichever fund manager you take, they will all have to definitely go through a period of underperformance. Now, if you don't understand the style and don't understand how the fund is making that outperformance over long periods of time, we will inevitably take our money during the underperformance phase, and only to see that the fund is again gone ahead and then done significant outperformance only had you stayed there. So it's very important to identify the right funds and then stay with them and then live through their tough times. So the key thing that we look at is that if the fund manager sticks to his process, we stick to the fund manager. If the fund manager does not stick to his process when bad times happen, we also give up on the fund manager. So overall, the solution that we have kind of tried out for us and which has worked reasonably well, both from a behavioral standpoint and from a performance standpoint, is the 5-finger strategy, where we essentially diversify across quality, value, growth, mid and small cap, and global exposure. And we put them together, and the portfolios have very, very low overlap. And over a 5-year cycle, these tend to do well. And historically, they've also fallen far lower than the Indian benchmark, especially even the large cap Nifty 50 benchmark. So they've fallen less than Nifty 50, which is lower volatility than large caps. But at the same time, they've given significant outperformance over both large cap index and the Nifty 500 index as well. So that's what I just thought I'll share with you. This is a core component of the behavioral series that we were running. First, we spoke about what are the behavioral traps in bear markets. And then we did one more session last month on bull markets. What are the behavioral traps? And this is the third part of the series where we are discussing on the behavioral traps in product selection. There's also one more, which is like, how do you identify a bubble? We have a 35 indicator list. So probably at some future sessions, I can elaborate you on how we think through that. So broadly, this is how we are. This is something very important. I just thought maybe it will be of help to all of you. Yeah, thank you so much.
Thank you, Arun. And thank you all for your valuable time. We are eager to hear your views of this. We will be sharing a link in the chat box for your feedback and response. We'll also be sharing a link via email in case you want to share your feedback later. Please take care.
Thank you so much, everyone, for joining. Bye.
Thank you.